What's up everyone, it's Scotty with MoneyVest. So in this video we are going to be talking about recession indicators. I did a video going over is this time really different, and there are some other indicators and some really interesting charts that I want to show you. And also from 2007 there was a couple updates and reports that also mentioned the word quote soft landing, which eventually led to being a very hard landing during the great financial crisis in 08 and 09. So hope you all enjoy this video and find it helpful. Make sure that you drop a like. I would really appreciate that. Subscribe to the channel if you haven't already. Really helps out the channel and of course grow it and push these videos out to more people. So I would really appreciate that. And this right here is going to be the chart that bar chart shared about 10 hours ago. And this was also the premise of my other video, right? We talked about this and how there is an inversion of the yield curve and how this time is that really different, right? That's the real question, because they tweeted the last 4 times the 10-year yield minus a 3-month treasury yield curve inverted. It led to the 1990s recession, the dot-com bust, the global financial crisis, and the 2020 recession. Is this time different? And that was literally the video that I did a couple days ago, talking about whether there's similarities to those instances or whether there are not, and if not, what is different now versus in the past. We talked about how there's been a lot of transfer of wealth from the public sector over to the private sector, and households and businesses, they were really well capitalized, and as a result they're able to service their debt, they're able to keep their jobs, and as a result unemployment's really low and economic growth is really high because consumer spending's high on the back of debt levels increasing, savings rate continue to deplete, but at the same time there is productivity, and as a result of that spending, businesses and companies continue to be well capitalized with cash flows and cash sitting on the bank, and they're also hiring, and unemployment continues to be low, and as a result there is no signs of any type of a recession, and the economy continues to perform really well. This right here is another really interesting chart that I came across, which basically goes over real GDP minus real potential GDP divided by real GDP. And when this number trades up to 0.08 or higher, that precedes a recession. Okay, so if you come over to what we have witnessed since 1970s, you'll notice that we actually did see a recession here, but then we came back up, right? So we came back up. So you'll notice what we witnessed basically was, let me just point that out. So I'm going to go that in red over here. So we basically came down here and then we make our way back up, right? So we get up to that 0.08 level, and then that obviously precedes this recession over here. Then we came back down, obviously, then we make our way back up, and when we hit this level, you can see there was a recession here, so that's the gray over here. And then of course we sell right back down, and again recession down over here as well. We make our way back up. So this right here is making our way back up, 0.08. Once again, boom, recession follows. We sell off, we make our way back up here, 0.08. We stay in that level for some time. Of course, recession follows again. We make our way back up, 0.08, and recession follows. And then eventually from 2009, 2010, all the way to 2019, we make our way back up to 0.08. And well, guess what happens? A recession follows yet again. So this right here is that level, and right now guess what, we sold off and we are now on our way back up, and we are in the 0.08 level. So every time we have sold off, we are made our way back up eventually at that 0.08 level. That has preceded a recession as well. This right here are the delinquency rates that I have talked about in our previous videos. So you'll notice that delinquency rates right now are still relatively low. We're still not as high as 07, 08 at over 4%. 4% is really the important marker to watch. And in this video, I'm also going to go over some of the very critical indicators to watch, okay? So we've already talked about unemployment rate, okay? Unemployed persons. If unemployed persons crosses over 8 million, I think that's what's going to be very concerning. That's number one, unemployed persons over 8%. Initial claims, if initial claims on a weekly basis every Thursday, so jobless claims crosses over 400,000, more or less 350 to 400,000, that's going to be a bit concerning. If delinquency rates start to rise above 4%, so right now you'll notice that we're sitting at 3%, and we have already more than doubled in the last few quarters. You can see that we've gone from like 1.5 closer to 2%, to well over 3%. And that right there, of course, is going to be that number. That's really where we are at the moment. But the moment we cross over 4 is when I think things are going to start becoming really interesting, because the higher the delinquencies, higher the potential for unemployment to also go. Now, if you're liking this video and if you're enjoying this content, please make sure to drop a like, subscribe to the channel. I also want to mention that we do have our sale, our Black Friday sale that does expire tonight. This is it. Literally today is Friday, and after tonight, the coupon code Black Friday will expire, and you do get access to 50 to 60% discount. So this right here is the full course bundle. Fundamental analysis, technical analysis, psychology, and options. Currently 70% off this entire bundle if you want to take advantage of that. This is literally the biggest sale we've ever had, and you get access to over 120 plus lectures and videos, spreadsheets, hours and hours of content, and a lot of videos. So link's going to be down below, so don't forget to take advantage. And also Black Friday sale from TradingView, 70% off. I have renewed my subscription with TradingView because of this discount and how significant that is. 70% if you are interested. Link's going to be down below for that as well. But definitely do check out the courses that are going to be 50 to 60% off. Individual courses are going to be 50% off. Bundles are going to be 60% off. And this one right here is going to be 70% off, which includes all 4 courses. And of course, join our Discord and Patreon with that 16% annual discount as well. Now, moving forward, this right here is quite interesting, right? This is from 2007. And this literally is from IMF, International Monetary Fund, that basically mentions soft landing ahead for U.S. economy. Can you believe that? That is absolutely crazy. This was August 6th of 2007, where IMF was calling for a, quote, soft landing. And they mentioned that United States should return to potential growth rate near 3% by mid-08, and housing market problems could still get worse. Fall in budget deficits tops expectations. Entitlement spending is a fiscal challenge. The U.S. economy should shake off the effects of steep housing market decline and return to potential growth of almost 3% by middle of 2008, while core inflation would ease. Little did they know what was going to hit them in 2008. Just absolutely crazy. They were expecting soft landing. And this right here was in February of 2007 as well. Fed chairman projects a soft landing for U.S. economy. And once again, you'll notice this again. These are headlines kind of resonating very similar scenarios of what we have seen from soft landing in 2024, 2025, as they're expecting inflation to come down on the back of a very, very strong economic growth and unemployment staying higher as well. Now, this right here is from Charlie Bilio, basically talking about the leading economic index declined for 19th month in a row and the longest down streak since 07-08. And the conference board is now forecasting a, quote, very short recession for the U.S. in 2024, pushed back from prior calls for a recession to start in Q4, Q3, Q2, and Q1 of this year as well. And this right here is what the market's pricing in now for rate cuts. Now, this has changed over the last couple days. Earlier, we were expecting 4 rate cuts and the first one beginning in May. So now the first one's going to beginning in June, and also only 3 rate cuts are being priced in from the market. So we have seen a little bit of that shift in the overall consensus of when the rates are going to get cut. And I think part of the problem here is the economy continues to be incredibly strong, right? Unemployment's low. The Federal Reserve is continuing on their battle of fighting for inflation, but at the same time, they are now more or less done, right? Because the market's not expecting the Federal Reserve to raise rates in December, 95.5% probability. They're going to keep rates where they are and steady up until June of next year, and then start cutting rates 3 times, bringing them down to 4.5, 4.75%. So that's really where we are. And look, my expectation from the economy going into 2024 is that we could moderate significantly in terms of that growth rate. A lot of that really depends on consumer sentiment, consumer behavior, and consumer spending. If people continue to spend as they are right now, that means we're going to take on more debt. We're going to keep spending. Businesses are going to continue to flourish, right? Because they're going to make more money, make more cash, more cash flows. And as a result, they're going to continue on this hiring process. There's going to be more demand. Unemployment is going to be relatively low because of the hiring that the businesses are doing. And as a result, it's possible that we're just kicking it down the road. We're just kicking the can down the road on the back of debt. But eventually, we know that if delinquencies start to rise, if consumer spending starts to shift, and unemployment starts to go up because there's earnings, recession, or there's a potential for earnings to decline for companies because of the lack of spending, that is when things get a little bit more troublesome. Now, that is only from a short-term, long-term perspective, right? That might be bearish short-term, but very bullish long-term, because we know what happens during recession, especially if inflation is back down to the Fed's target below 2%. We know what's going to happen with rates. Rates are going to get cut. They may not come down to 0%. I think 0% and 0.5 and like sub 2% levels are long gone for the U.S. economy, in my opinion. But they could stabilize at 3, sub 3%, 2.5, in and around those levels in the next potential recession. Something to keep in mind. So, hope you guys enjoyed this video. I am somewhat cautiously optimistic going into 2024. So far, I mean, the markets have done really well in 2023. The nasdaq's up like 30+%, and there's a lot of individual stocks that are up like 40, 50, 60, 70%. So this year has been phenomenal. It's been a record year, and I'm sure that's true for you as well, as technology has done really well. If you've been following the channel, if you've been following our analysis, I mean, technology has done incredibly well, so I'm super happy for that. So congratulations. But going into next year, just be aware that these rallies are not going to last forever, right? We're going to have to hit a wall at some point, and we may have to come to agreement with some stabilization, some moderation in the overall momentum higher. And going into next year, I'm somewhat cautiously optimistic. We'll be taking advantage of opportunities, of course, if markets do end up selling off on the back of a recession, because I know that eventually, if the rates do get cut, that's going to be very bullish for the markets long term as well. So that's where I stand. Let me know in the comment section down below. What do you think about the recession probabilities and going into 2024? What are your thoughts on the market? As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Don't forget, join our Patreon, Discord, 16% annual discount available till the end of this month. Black Friday sale available until tonight. After midnight, it does expire. Coupon code Black Friday. Individual courses 50% off, and this bundle right here 70% off. Includes all 4 courses that you have lifetime access to. Link's going to be down below. As always, happy investing. I'll see you all in the next video.